Hi there, welcome to another video from Funding Store discussing the different types of funding. Today we're going to have a quick look at working capital funding. This isn't particularly a type of funding, it's more an area in your business which needs funding. So the first thing to do is to discuss what is working capital. Well, as you can see from the chart, that sums it up really. Working capital is the money moving around day by day in a business between your cash, bank account, creditors, the people you owe, debtors, your customers that owe you money, stock that you may buy if you have stock, etc. So the money's moving around in and out, up and down, and the amount of facility you might need for your working capital will vary on lots of things. It will vary on the time of the month. So if you've got to make your salary payments, your pay as you earn, your VAT, and it will vary, depend on how quickly your customers pay you, which is a big problem in the UK at the moment, late payment for small businesses. And also, obviously, how quickly you pay the people you owe. So working capital is a very important part of the lifeblood of a business, and the traditional provision of working capital has come from the main banks historically, and they would provide overdraft facilities to many businesses, which would fluctuate, sometimes going into the positive and then going back into negative, depending on what was going on inside the business. A lot of banks recently have actually been approaching businesses, particularly those who've been at the limit of their overdraft facilities, and requesting that these facilities, this amount of debt, is turned into a term loan. There are various reasons for this internally in the banks and their own balance sheets. But there's also the factor that this means that the business itself is repaying the debt rather than it staying at a particular level all the time. But looking at the other options for working capital finance, one has to go and look at the assets that it's based on. So in most companies, apart from retail, there will be sales invoices issued to the customers, which probably won't be paid straight away. Depending on the quality of the customers, what the business is supplying, and the quality of the invoices themselves, the length and the detail on the invoices, then these invoices can be financed. There are different kinds of finance: invoice finance, factoring, single invoice discounting, etc. And these are all explained on our website. But in principle, sales invoices in a business is probably the first place to look in terms of creating working capital finance. The invoice finance company will pay the business 80 or 85% normally of the invoice amount as soon as the invoice is issued, and then when the invoice is paid, they will repay the balance, assuming they collect it, less their fees. So it is an efficient way, but you've got to watch for the costs and exit charges, etc. The other area where working capital finance is available, but it's harder to get, is stock finance. So if you're buying stock and you need some funding to buy the stock, there are certain providers that will provide finance against some of the value of the stock. Again, it depends on the stock, what you're buying, whether it's resellable. If it's very bespoke, it might be more difficult. And also who you're selling it to, what you're buying it for. Is it speculative? Is it for an order? Again, it's complicated. So that's, I think, it. It's a general subject. The best thing to do is to call us on 01565 756 141 to have a chat about what your needs are, and we'll guide you in the right direction.